I am the Head of Communications and Customer Experience here at Menak, and I will be your host for today. There has never been a more important time for investors to deepen their knowledge about China and the significant potential growth opportunities. China is on track to be the world's largest economy, and by some metrics, it has already superseded the US to take out the #1 spot, as evidenced in a recent IMF report. In just 40 years, China has transformed itself from one of the poorest countries in the world to a global economic superpower. While there are undoubtedly complexities, geopolitical frictions, cultural and ideological differences, investors simply cannot ignore China. Previously, investors outside of China faced many obstacles when trying to access the world's growth engine, but this has been changing. China is now making significant strides to open up to foreign investment with new policies and laws aimed at promoting and protecting such investments. Similarly, it is now far easier for individual investors to gain direct access to China A shares. A select few fund managers, of which Menak is one, have the license to buy stocks on China's Shanghai and Shenzhen exchanges, which, just to give you some context, collectively represent the second largest stock exchange in the world. Access to these stock exchanges means access to China's primary market, which offers a far larger and more diverse opportunity for investors. And this is an important distinction, as there are many funds that include a China focus, but a lot of them are actually only able to target a limited number of Chinese companies which are listed on exchanges outside of China. So, what else do investors need to know about China? Well, this is what we're aiming to answer for you today in the inaugural China Investor Symposium. We have a panel of highly accomplished independent experts on China and the global economy to bring you deep research-based insights and analysis. And yes, that will mean quite a lot of graphs, but I promise you it will be worth it. So today's event, we're going to cover 3 key areas. Firstly, we'll deep dive into the macroeconomic trends and policies shaping China, driving growth in key sectors, and by proxy, the investment opportunity. We'll also be looking at exploring Australia's relationship with China and what the future may hold in the new global order. And finally, we'll take you a step back to look at China's economy and performance through a global lens. Now, before I introduce to you our first speaker, we've got 2 important things to note. Firstly, what we talk about today is general advice only. This is not personal financial advice and does not take into account your individual circumstances or financial objectives. And we always recommend that you speak to a financial advisor or broker to best determine what products and investments are suited to your particular needs. And secondly, if you have any questions for your speakers today, please send them through at any point. You can use the chat function at the bottom of your screen. Just make sure you let us know which speaker you would like to answer your question, and we will try and get through as many of them as we can at the end of the event. Okay, that's enough from me. Let's get started. I am delighted to introduce to you an expert in China macroeconomics, monetary policies, corporate strategies, and economic management. Dr. Mingchun has more than 2 decades of experience in finance in roles such as CIO and Chief Economist of Deepwater Capital, Senior Partner, Chief Economist of China Broad Capital, Managing Director, Head of China Research, and Chief Asia Economist at Daiwa Capital Markets. And to be honest, many more highly impressive titles. It is safe to say our first speaker is highly accomplished. Dr. Sun is currently Chief Economist at Haitong International, a leading stockbrokering firm and investment bank. And Dr. Sun joins us now from Hong Kong. Welcome, Dr. Sun.
Thank you very much for having me. It's a great pleasure to be here.
Well, it's our pleasure as well. So thank you, as I said, for joining us. I know it's a little bit early there in Hong Kong. Dr. Sun, can you please share your analysis and thoughts on what is happening in China?
Sure. Maybe you can start with the slides. First, good morning, everyone. Very happy to be here to share with you my view on China economy for this year. So I'm going to show you a lot of charts in the next 20 minutes. But the first one is about the shape of the recovery in China. You can see it's very clear. We are seeing a very strong V-shaped recovery in China's economy. The lowest point was reached in the first quarter of last year. Actually, we saw about like 6.8% drop in Q1 GDP last year. This is the only drop we saw over the past like 20 years, 30 years, quarterly drop, I mean. But now we have seen a full recovery. By the end of last year, in Q4, we have seen growth coming back to 6.5%. For the full year, the growth number was about like 2.3%. This was the lowest annual GDP growth since 1978, since the reform started in China. Let's go to the next page. Even so, even China's growth, last year was the lowest in past like 40 years. Still, this among the top 10 economies in the world, China's growth was the only positive one. You can see all the other 9 countries have negative growth. More important this year, according to IMF, China's real GDP growth will be 8.2%. My own forecast is something like between 7 to 8%. But I think the consensus is something around like 8%, I think. So what this puts China as a very, far ahead of other countries, because if you look at the other 9 countries, most of them will achieve positive growth this year, but the growth number are less than a decline last year. So that means for the rest of the 9 countries, by the end of this year, the absolute level of GDP is still below that of 2019. So China is, clearly the best performer among these coronavirus. Please go to the next page. So this is mainly the reason China's economy recovered strongly is mainly because the country had a great success in containing the COVID-19 pandemic. If you take a look at this chart, you can't really see China. China is at the bottom. Its current number, the latest number, is the total confirmed cases of COVID-19 infection is only slightly above 100,000 now. 100,000. This is much less compared to over 25 million in the U.S. Because of that, I was back in China in September through November last year. Basically, almost everything is back to normal. So that's the reason the economic recovery is very strong, except for a very limited number of sectors. All other sectors are going back to pre-COVID-19 state. So next slide, please. Another reason for the quick recovery of China's economy is the policy reaction. China also run, pretty stimulative fiscal policy and also monetary policy last year. If you see this chart, if you look at the M2 money supply, broad money supply growth, it's quite clear last year we see a jump in the growth rate of money supply. But what's interesting is that you see the numbers, the growth numbers was around like 10 to 12%, clearly above the previous 2 years, which is around like 8%. But compared to 2019, if you remember, after the global financial tsunami, China had a very big stimulus package. We call that 4 trillion stimulus package. At the end of the day, it's much more than 4 trillion. We saw at that time, M2 growth jumped from 15% to 30% at highs. And this time, we also see monetary policy loosening, but it's much less, much less aggressive than in 2009. So this is very good in my view, mainly because the government, the central bank, and also Chinese government are quite aware of the negative impact of loose monetary policy. So this also makes China, the People's Bank of China, stand out among other major central banks because it didn't really use something like unlimited quantitative easing or very aggressive monetary policies, kind of prudent. And this actually helps the currency, helps people's confidence in China assets. I will talk about that later. If you go to the next page, I'll talk about the fiscal policy side. Uh, um, Oh, sorry. This is the industrial production. On the supply side, we can see production has had a very strong rebound. Uh, the latest number for industrial production is already 7.3%. It not only recovered, but also, you know, it's much higher actually than before the pre-COVID-19 level. It's the highest growth in the past 21 months. Part of the reason was because of very strong export orders, export growth. If you turn to the next page, we can see that on the demand side, we are also seeing V-shaped recovery, nominal growth of fixed asset investment, also retail sales, both consumption and investment have recovered strongly. And the number, if you can see, generally, basically the retail sales is almost back to the pre-COVID-19 level. Investment side is a little bit weaker. Overall, I think we see both supply side and demand side recovering, but overall supply side recovery is stronger than domestic demand. Part of the reason is because of the export. If you can turn to the next page, you can see this is China's export growth versus one of its leading indicator, that's the US ISM. What's interesting that at the beginning of the COVID-19 pandemic, most of the economists, including myself, was expecting China's export growth to be pretty weak last year. But actually, we were all surprised by the strong recovery, especially in the second half of last year. It's mainly because part of the reason is because of I think it's because of the supply chain disruption in the rest of the world, and some of the export orders were actually shifted from other places to China, and I think this is part of the reason. And also we know the surge in the price of container lines. So it's mainly because a lot of exporter orders all crowded to China. And if you look at the leading index, US ISM, this is leading index for China's exports. It seems like we are going to see even stronger numbers in the coming month. Um, that's good and bad. Good is that we did see better than expected export orders, but some people is kind of worry about what would happen if what would happen to China's export growth if the rest of the world is back to normal after this pandemic. So it can have a little bit impact on the export numbers. Please go to the next page. If you look at, I just talked about this China's fiscal policy. China's fiscal policy was also quite supportive last year, but not as aggressive as in other places, other countries. We see something around like 5 to 6%, deficit last year, larger than the usual deficit of less than 3%. But still, for China, this is China's fiscal position is still very strong compared to other economies. Its government debt to GDP ratio is only 62% in last year. This is if you compare to other countries, this is very low. And more than that, we need to keep in mind that Chinese government has lots of state-owned assets. the total amount is something around like 100 trillion RMB, which is about 100% GDP. If needed, the central government can actually use these state assets to fund its fiscal stimulus plans. If you go to the next page, let's talk about the monetary policy for this year, for 2021. A lot of investors are quite worried about tightening in China's monetary policy. We have seen some slight changes over the past few months, but to me, I think it's not a change in direction. It's more about trying to be practical and flexible. And if you look at this page, the Chinese government before last year, the Chinese central bank has been trying to keep the so-called excess liquidity at around like zero level, which is the excess liquidity is basically the difference between broad money supply and nominal GDP growth. If you can see in the previous 3 months or 4 months, previous 3 to 4 years, it's basically around like 0%. But last year, because of the pandemic, the increased money supply, and because the growth was also low, we see excess liquidity reaching 7%, 7.1%. For this year, my guess is they are going to try to get this back to around 0%. That means this year, broad money supply will still be around like 9 to 10%. Because if we see GDP growth at around real GDP growth at around like 8%, inflation GDP deflator at around like 1 to 2%. That means nominal GDP growth will be like 10%. So if we keep excess liquidity at 0%, we still see money supply growth at around like 10%, so which is the same as last year. So I don't really worry about monetary tightening. I think that People's Bank of China is very, I think they are very smart. They are also very flexible in determining their monetary policy. If you go to the next page, we can understand why they keep this, this kind of a flexible but a little bit more prudent stance as compared to other central banks. It's mainly because China's task, the whole country had a task of keeping leverage ratio like stable for the past 3 years, and also this task is also going to be an important one for the next 2 years. If you see this chart, this is the number from BIS. This is credit to GDP ratios for non-financial sector. Since 2016, the government has been trying to keep this in control. It actually very successful. You can see the ratio was stable for the past 4 years until last year. We last year, because of the pandemic and the policy reaction, we see this number, this ratio of credit to non-financial sector to GDP jumped again to 221%, which is 10% above its trend. The government has been quite worried about the potential financial risk resulted from high leverage ratio. Last year was a abnormal situation that allowed that to happen, but this year I think they need to keep it in control. They don't have to make it drag it back, but I think they will try their best not to make it rising too much. So that's the reason monetary policy won't be as easy as last year, but it will also won't be very tight this year. If you go to the next page, the result of this kind of monetary policy is actually very supportive for China's currency. Last year, the RMB actually had a pretty big appreciation against the US dollar, which surprised a lot of people. Initially, people worried about capital outflow because of the pandemic, but actually at the end of the year, we see lots of capital inflow, and the currency also appreciated a lot. But this is actually only, this is still in, I would say, this is China's currency has been in a appreciation trend for the past 25 years, 26 years. This is only this is still within the trend. And the prudent monetary policy as well as solid economic fundamentals in China helped a lot for the currency to strengthen. If you go to the next page, with the strengthening currency, and also if you look at the yield difference, the yield spread between between China and US, you can see the 10-year government bond yield in China is about like 200 basis points higher than in the US. So it's very simple calculation for investors, because you get a 5 to 10% appreciation in the currency, as well as a 2% difference in yield. So investing in China asset, especially think about this government bond, is a safe bet. So that's why we see a lot of money coming in into China to buy bonds, and also as well as the stocks. If you go to the next page, the reason for buying stocks in China is not just for the currency appreciation. It's mainly because the economy is still in a structural transition from the traditional kind of sectors to the new economic sectors. And what happened in the past 10 years, if you visited China in the past, in recent years, not last year, I know, but basically, if you have been there in recent years, you can see the big change, a huge change in the economy in terms of people's lifestyle as well as business models. It's mainly because we have seen a lot of infrastructure built over the past 10 years or 20 years that helped the change in business model and also in lifestyles. One of the things I want to mention is this for the coming years is the installation of this 5G technology. This is the forecast by the Minister of Industry and Information Technology. You can see by the end of next year, we are going to see lots of more than half of the country will be covered by these 5G communication networks. The impact of this is very, very big, because if you think about what happened in the past eight to 10 years, especially in the past 8 years, after 4G telecommunication networks was installed in China, lots of internet companies, lots of the downstream users of this 4G technology, grow very fast. Without the 4G technology, we are not going to see all these big names in the stock market in China. So if we think about those changes, and the 5G technology application in China will bring a lot of change in China's economy, China's business sectors, and also in Chinese people's lifestyles. So that's something I think will bring a lot of investment opportunities for investors. Let's go to the next page. Another area I think investors should pay attention to is on the environmental side, on carbon technology, for example. If we all know that in September last year, the Chinese government announced its target to achieve carbon neutrality in 2060, to peak its carbon emission in 2030. Both of these goals are ambitious because it's think about the growth of China's economy. It's a demanding job. What we know from this chart is that the optimal path to reach the peak of emission by 2030 tells us we can only see 5% increase in total carbon emission in China. But China's growth is still expected to be around like 5% per year in the next decade, which means the overall GDP will be 63% larger in 10 years' time. But total emission can only increase by no more than 5%. So that means we need a lot of investment in carbon related technology in changing the energy structure in the country. The estimate that in the next 20, 30 years, we are going to see over 100 trillion RMB investment, over 20 trillion US dollar investment in related infrastructure in China. So that will be that will create a lot of investment opportunities for investors. The next page, which is the last page, is about ESG investment opportunity in China. It's all, this carbon neutrality is one of these ESG investment opportunities. But overall, actually, even before Chinese government announced this carbon neutrality target, we already see, people's interest in China on this ESG investment. Actually, back in 2019, we have already seen that. A lot of investment funds were created with ESG themes or green themes. And this is one of the A-share ESG ETF that was launched by Haitong International last year, in October last year. The performance is pretty good. So basically, I think the ESG investment is something like the investor should pay attention to in the coming years. I will stop here. Back to the anchor.
Well, thank you so much for that, Dr. Sun. Can I just to recap and sort of circle back, you mentioned that sort of the new economy, there's some accelerations with the new economy, and you mentioned technology. Are there any other sectors that are looking to accelerate in the coming years, or even in this year in particular?
I think consumption is still an area that people, investors still like. I also think Chinese GDP per capita has just exceeded, I think just exceeded $10,000 US, and it's I think there's the so-called consumption upgrade will continue, especially consider this is a country with a 1.4 billion population. So I do agree that the consumption sector is still a sector with great potential. The only issue we still need to keep in mind is that most of the stocks are very expensive. So that's the thing I want to highlight.
I guess expensive for a reason. Well, again, thank you very much, Dr. Sun. We're now going to shift focus to our own shores and look at the Australia-China relationship. If recent headlines are correct, relations are at their lowest point in history. Australia's engagement with its largest trading partner is without a doubt a hotly debated topic, and our next speaker is perfectly placed to give us a real insider expert view on this relationship, past and present, and what the future may hold for Australia, the challenges and the opportunities. Dr. Jeff Raby is an economist and a diplomat, and he is also the former ambassador to Australia, former Australian ambassador to China. And he's also an author and who's written a book recently. Dr. Raby, thank you so much for joining us. Can you tell us, trade disputes, tit for tat, diplomacy, what's happening and where does Australia go from here?
Thank you, Vanessa. Thanks very much to Van Eyck for hosting this event. Yes, as you said, I mean, these are very, very hot topics, and it was an accident, I guess, that my book came out in the lowest point that the relationship has ever reached, and consequently has been flying off the shelves. But as you correctly say, the relationship's at its lowest point since diplomatic relations began in 1972. And there are many reasons for this, but I think it's extremely important to put the current situation in context. And what we're living through and have been for the past 15 years or so is the greatest power shift in world history, the shift of power across the Pacific from the United States to China. The US is still the dominant power, but China is a rapidly ascending challenger to US global primacy. And what we've seen in the past 8 years or so is the US shifting its position from policy based on engagement with China, which stood the US and Australia and everyone else in very good stead for 40 years after great relations were normalized between the US and China, and of course between Australia and China, and moved from a position of strategic engagement with China to a position of strategic competition. Now, 10 years ago, the geopolitical analyst Hugh White wrote a very significant and important book, and very prescient book, called The China Choice. Many people who have never read the book, although most people know the title, which is usually the case with good books, believe the choice was Australia's choice, whether we would have to choose between our security with the US or our economic prosperity with China. But Hugh White was writing about the choice the United States would have to make. As China rose, would the United States continue policies of engagement with China and continue to cede strategic space to the ascendant power? Or would the United States at some point, like many other dominant powers, seek to resist the ascendant power? The latter choice, White warned, was the path to war. And he hoped and suggested that there would be mechanisms and ways for the US to cede strategic space to China in order to avoid war and to accommodate China's rise. And not long after White wrote, many studies were coming out. There's been a constant drumbeat of such studies out of mainly conservative think tanks in the United States, Destined for War by Graham Allison and other such books, which basically talk about the inevitability of conflict between the United States and China. Hugh White, in his book, made the very prescient observation that were the US to decide to resist China's ascendancy, that would have profound implications for the Australia-China relationship. And what has happened is that over the past 8 years, the US has moved gradually and then with greater rapidity to a position from engagement with China to containment of China. And that is the position we find ourselves in today. And for Australia, because of our alliance relationship, we have taken the position that our interests are aligned with those of the US in resisting China's ascendancy. Now, in about 2017, we wrote in Australia a foreign policy white paper, which still talked in terms of cooperation with China in areas of mutual interest. But at the same time, and I'm sure certainly well known to Australian security and foreign policy analysts, the US National Security Agency was writing quite a different assessment of China, which came out in about October, November 2017, which stated boldly that China was a strategic competitor of the US and therefore had to be resisted. And it is about that time that our policies towards China started to substantially harden, and we are where we are today. Now, it wasn't all overnight, and you can go back to 2013 when Obama in Darwin announced the pivot to Asia and the increase of rotation of marine troops through Darwin, clearly aimed at China. and US policy shifted progressively in this direction. You can see Australian policy moving in parallel. First of all, for example, after we had a very fractious debate in Cabinet for nearly 6 months over whether to join the Asia Infrastructure Investment Bank, and finally we did, we then very quickly made it clear to China that we would never be part of the BRI, the Belt and Road Initiative. Then following that was the Hague Court of Justice case over the South China Sea, taken to the court by the Philippines, and found in favour of the Philippines. And Australia was the most strident country in its support for the judgment and, if you like, condemnation of China's behaviour in the South China Sea, way more than any other country, US allies like Japan or others. That was followed fairly quickly by the comprehensive banning of Huawei. No other country at that time had banned Huawei, not even the United States. And no country until very recently had banned Huawei comprehensively from participating in any aspect of the 5G whatsoever. So, for example, the United Kingdom, with whom we have a very, very close and tight security intelligence relationship, it didn't announce a comprehensive ban on Huawei till last year, and that was under enormous pressure, particularly from the outgoing former US Secretary of State, Pompeo. Up until then, the UK had a policy of allowing Huawei to participate in some 60% or thereabouts of the 5G network, finding that there were some elements that were too sensitive to allow Huawei into, but by and large, for the most of it, Huawei could participate. So from an early stage, we began to make ourselves an outlier in how we, as a close US ally, joined the US in resisting China's ascendancy. And then we go into the anti-foreign interference. Now, anti-foreign interference law is a very good idea. The question we should ask the politicians is, why did it take them so long to introduce such a law? The problem with how it was done by the Prime Minister at the time, Malcolm Turnbull, in terms of our bilateral relationship with China, is that it was made about China. It was presented as being really about China. And to underscore that, the Prime Minister during the Banalong election of that year spoke in Mandarin of a fashion, paraphrasing Chairman Mao's statement in October 1949, when the People's Republic of China was founded, that the Australian people had stood up. Now, it's one thing for Chairman Mao to say the Chinese people had stood up to 150 years of oppression and domination by foreigners, but it was clearly a very pointed statement that the Prime Minister was making at the time, Malcolm Turnbull, that this was really all about China and Australia standing up to China. And so these things have accumulated, including much, much tougher rules than the third, tougher cybersecurity. Again, always the subtext and the backgrounding and the leaking to the media is that it's always about China. And of course, we know many, many countries, all countries, including Australia, engage in cyber activities or cyber warfare to some extent. And so roll the clock forward, and we get to March of last year, when the Prime Minister unilaterally, without any company, no like-minded countries joining us, the day after a much publicised telephone with then President Donald Trump, called unilaterally for an inquiry into the origins of COVID-19. Clearly was a very provocative statement. Clearly, it should have been done in company of many other countries. But the way it was done, obviously really upset Beijing further, coming on top of the way Australia had so directly, manifestly joined the US in resisting China's ascendancy. And so the Chinese the ambassador behaved badly. I mean, there was a very threatening statement by him, the so-called wolf warrior diplomacy, and threats of economic coercion, which of course have now come to pass. And we responded, and the government took a decision in April, not publicised, but did take a decision in April to engage in tit-for-tat retaliation with China. And so since April last year, we've been in a downward spiral in the relationship of tit-for-tat retaliation. And that really brings us to where we are today, with various Chinese trade measures applied to a range of Australian commodities and products, from barley to coal, timber, wine, lobsters. Negative statements being made in China about studying in Australia, and so on. So this has been a very fraught and difficult period, and the Australian government's position on this, and this is a key, I think, is that Australia hasn't changed. Australia's done nothing wrong. We're a victim of Chinese bullying, and China is wanting to make an example of Australia as a warning to many other countries. Now, some of that is true, but what's not true is that Australia hasn't changed, because Australia took a decision to move from a long-standing policy of engagement with China to join the US in containment of China in a way that no other countries have done. So in doing so, we have made ourselves an outlier, and hence the remarks last week of the New Zealand Trade Minister, which was basically drawing attention to that fact, that other countries have managed their differences and difficulties with China in a very different way, and haven't brought upon themselves this sort of economic coercion. And economic coercion is a very important instrument in China's statecraft. It's not that it's excusable. It should be rejected. It is very bad behavior, and it's in breach of China's WTO obligations, and of course in breach of bilateral obligations it has with us under the FTA. To say why it's important is not to excuse it, but it is a reality we have to deal with. And it's because China has a very limited armory of instruments in its statecraft, and nearly all of them are economic. Some are positive, the use of investment, for example, or access to China's market, and some of them are negative, such as we've been experiencing with a whole range of measures directed against us. So when we look at the world order, which is really where my book begins, we see an order that's changed fundamentally. It's no longer a unipolar world led by the United States, a country with whose values and institutions we share. We have been fortunate in Australia for all of our history to live in a world that's basically been led and dominated by a major power with whose values and institutions we share. First, it was the UK or Great Britain, Pax Britannica, and then since the Second World War, Pax America. Today, we are very much on our own, and we're living in an order where there are two dominant powers, the US and China. Each dominant power exercises outsized influence within its own sphere of interests, but it's no longer a unipolar world. And we in Australia find ourselves having to navigate an existence in which our economic interests are in the sphere dominated by China, or most heavily influenced by China, and not in that of the United States. So in the last part of my book, I described the outlook for Australia as Australia's dystopian future. And by that I mean we have lost the comfort and certainty of a world in which we shared the values with the dominant power. We are abandoned to a large extent in this new order, and the new order consists of many influential countries which are not democratic countries and with whose values we don't share. And we need to work out in Australia how we build relationships in this new order, how we balance China's power to some extent. Certainly, we make sure that China understands that there are costs for bad behavior, but we need to find a much more independent foreign policy, which implies standing further apart from the United States. At this point, we're a long way from getting there. And both sides of politics in Australia have decided that, for better or for worse, we will double down on joining with the US in its policies of containing China. The Biden election is very, very important for this. And it's too early to say where it will all end up. But there are a couple of things I think we can be clear about. Firstly, the tone and rhetoric has changed and will change under a Biden presidency compared to a Trump presidency. And I think just a change in tone and rhetoric will help a lot and will open the path to a more constructive dialogue between Washington and Beijing. Secondly, Biden in papers that were published under his name, like in Foreign Affairs, in the run-up to the election, set out an agenda of strategic competition with China together with strategic cooperation. And that's a big move forward, in my view, from where we were under Trump. And the big issues of the global commons, which Biden wants to address, like climate change, and must address, like pandemic and nuclear weapons in North Korea, require cooperation with Washington. So when we look to the future, my hope is that in time, the need for strategic cooperation between Washington and China will lead to a much more constructive relationship between Washington and China so they can work together on the global commons and the big issues. And in doing so, I would hope that this would provide something of an off-ramp to enable Australia to begin to reposition itself in its relationship with China. But as we can see, because the Prime Minister has made some quite conciliatory comments in terms of the relationship with China, we will need to see clearer action on the Australian part. Because the reality is, at the end of the day, this is an asymmetric relationship between Australia and China. Canberra really hates anyone who says what I'm about to say, but the reality is we need China more than China needs us. And all talk of diversifying markets, decoupling and whatever will not change that reality. We are utterly economically dependent on China because of the complementarity between our economies. But more than that, China is the dominant power already in East Asia. And whatever we wish to do in the region or beyond requires at least Chinese acquiescence, if not support. So we have some major challenges in Australia to get this relationship back on track. We need to get it back on track. We need to stop talking about ourselves as victims of China and take a hard-headed realist position on this and just figure out for ourselves how we navigate our way back to a more normal relationship. And as I said, I do think there is a possibility of an off-ramp with the Biden presidency. Finally, I think we need to look also at where the US interests line up beyond what we've been discussing. And I think that all this talk about decoupling, resisting China in these ways, probably will not lead to much. I mean, Xi Jinping has already announced last year the policy of twin circulation. And I read that as pretty much old-fashioned import substitution, but also there's a sense in which Xi Jinping is saying, well, if you wish to decouple, bring it on. We will just invest more in advanced technologies. We still will meet the targets of Made in China 2025. And talk of decoupling will just accelerate the domestic effort in China. So I'll conclude at this point. Look forward to taking questions. Thank you very much.
Thank you so much, Dr. Raby. Your comment around we need China more than they need us, it seems very logical. And I just wonder, so if one was to catalogue all of the headlines and media stories that involve China, I mean, overwhelmingly they would be probably more negative than positive, and sit in that kind of fear zone of Australia being taken over and Australia needing to try and prevent that. How much do you think this rhetoric is driven by the Australian people having, a level of fear because cultures are different and for various reasons, and that driving media and that driving policies and politics, or it coming from the politicians and then that kind of rhetoric flowing down to the public?
Yeah, look, I think the latter, largely. Sure, I mean, there's the reality of China being so big and we're so small relative to China, but it goes to the heart of my analysis, which is this shift in the US position from treating China as a strategic partner and pursuing policies of engagement to containment. And therefore it comes not just for it's not the politicians so much, it's the conservative think tanks that have been in Australia, that have been so heavily influenced by similar think tanks in Washington in particular. And that shaped the policy narrative. And in my La Trobe University oration of October 2019, I set out very clearly what I saw as the China threat industry that's been created in Australia. And there really has been an industry created around this. And what's lacking, I argue, is any sense of proportionality or context. And for all the effort, if you like, to oust Chinese agents of influence, of undue interference in our politics, all of these things, there's been almost no bodies. I mean, we haven't seen hardly any evidence of this threat. Now, there is a threat, of course, but it all needs to be put in context. Our responses need to be proportional, and neither context or proportionality exists with respect to the China threat.
Well, thank you so much. There is certainly a lot to consider, and how Australia plays its cards will certainly have long-term and far-reaching impacts, I'm sure. So I know we've got quite a few questions coming in for you, Dr. Raby, already, but we'll wait to the end of the event and we'll come back to you. Just for everyone's knowledge, Dr. Raby's book is called China's Grand Strategy and Australia's Future in the New Global Order. So our final speaker for today is going to help bring a global perspective to China's rise and help us understand performance in the context of the rest of the world. Menak is an esteemed economist who has spent his time in all the biggest investment banks and started up his own Menak Advisors in 2013. And we are delighted to have him in the studio today. Thank you so much for joining us, Gerard. How are you?
Thanks, Vanessa. Very good.
Oh, that's fantastic. Well, please share your thoughts on how China is from a global perspective.
Thanks, Vanessa. Look, I'm going to address really 3 points in this presentation. The first is that China's remarkable economic performance has not yet been matched by investment performance. And as someone who looks at the world through a prism of investment opportunities rather than economics straightforward, that's a major discrepancy that needs to be addressed. The second point is about globalisation. And globalisation was tremendous for Chinese workers, not as good for investors, and it was the opposite in the developed economies. Not so good for workers here, great for investors. And then finally, just to emphasise that from an investment perspective, I think the key change that we need to see is a better return, a better allocation of capital within China. So I'm going to run through a few slides to sort of flesh out these points. Let's start with, I guess, the most obvious point. Unless you've been on a desert island for the last 3 decades, Chinese growth has handsomely outstripped that in the rest of the world. And this slide is just showing you the levels of real GDP, China versus the rest of the world. In that context, China has been part of the surge of emerging economies, particularly in Asia. And this slide is highlighting the point that really the gap is not between emerging markets and developed economies, it's emerging economies within Asia, other emerging economies such as in Africa, Latin America or Europe, have been performing more in line with developed economies. And so it's really been an Asian decade. But let's get to the key point from an investment perspective. This next slide shows the massive disconnect between the real economic performance in China and their equity index. And you can see from this slide that the equity index has basically gone nowhere in real terms over the last 30 years, despite that massive surge in Chinese GDP. I want to hone in on why there's been this major discrepancy between Chinese economic performance on the one hand and their investment performance on the other. And to do that, I'm going to do a comparison between China and the US on a number of fairly simple measures. So on this next slide, I'm just going to show the level or growth of GDP, US versus China from 1996. If anybody's wondering why I've used the comparison from 1996, it actually relates to the equity index that I'm going to reference later on from MSCI. It's a well-known index provider, and their principal China equity index started in 1996. So that's the reason that we're starting that comparison. What this slide shows is really the remarkable growth in China. Nominal GDP since 1996 has averaged over 12% growth. Now, the miracle of compounding means that that is a 17-fold increase in aggregate Chinese GDP. Compare that to only 4% growth in nominal GDP in the US, so their GDP has doubled. So huge differences also reflected in the gap between real GDP. On the next slide, I'm looking at listed sector earnings. Now, I made the assertion before that there's this big disconnect between China's economic performance and its investment performance, whereas this slide is actually showing that earnings in China have absolutely skyrocketed, up 45,000% since 1996. Now that of course partly reflects the fact that back in the mid-1990s, China was just emerging from what was obviously a communist economic organisation, so the private listed sector was exceptionally small. It also reflects the fact that the number of stocks in their index has increased. If you look at the increase in earnings per company, it's still an amazing 19% per year since 1996. Now that compares to the US. Over the same period, individual companies have on average increased their earnings by 6%. So surely that's fed through to better equity performance, better returns for investors. And the simple point is it hasn't. This chart looks at equity market performance since 1996. The solid bars are total returns, so this is capital appreciation with dividends added. And on that basis, the S&P 500, the US index, has delivered over 9% return per year. In China, it's been 5%. And if you're looking at just purely the price, ignoring dividends, the comparison, the gap is even starker. 7% in the US, less than 2% per year in China. What on earth is going on? Well, the key story really is it's not earnings that drive equity performance, it is earnings per share. Here's the earnings per share comparison between the US and China. In the US, earnings per share on average has increased 5.3%. In China, in US dollar terms, it has fallen. It has fallen. So just let's look at this comparison here on this slide, comparing the gap between, on the one hand, aggregate earnings and on the other, earnings per share. China's key investment problem has been the dilution, the fact that massive earnings growth has not fed through into earnings per share. I want to look a little more deeply in this puzzling statistic. Now have a look at this slide. I need to explain it to you. Each dot on this chart represents an individual market. The horizontal axis shows how fast aggregate earnings have increased in that market over a number of years. For most of the markets in this slide, I'm going back to the early 1970s, not so far for China. The vertical axis is earnings per share growth over the same period. Now that green dotted line is at 45 degrees. If earnings and EPS were the same, every dot would be on that green dotted line. What you can see is every dot is below the green dotted line. So over time, in every market, EPS growth is slower than earnings growth. So this dilution is quite normal. And indeed, in faster growing economies, the dilution tends to be larger, which is why over time, there's almost no correlation between economic growth and equity performance. But now, where's China on the slide? There it is, the dot on the bottom right. Even by the standards of fast-growing economies, China has had enormous dilution. China has been world's best practice diluter. The gap between earnings and EPS is enormous. Contrast that to another large emerging market economy, India. Now, India has actually had much slower average earnings growth, around 10 percentage points per year, slower growth than China. And yet India's EPS growth has been almost 10% higher than China. What this slide shows is relative to what you would expect as represented by that blue line, India has much less dilution than you would normally expect. China has seen much more. So the big problem is the allocation of capital. Now let me show all this in one final slide to drive home this point about dilution. This slide is showing you the history of earnings per share growth in China in red and its GDP growth in blue. And there is obviously through the cycle some correlation. That's because companies have operational leverage. When sales pick up, margins tend to improve. When sales decline, margins come under pressure. But there's a trick to this chart. And the trick is the two vertical axes are on different scales. The earnings per share axis is on the left-hand side. The nominal GDP is on the right. And what you'll see, and I've circled it there on the slide, is the right-hand side where it's 10% GDP corresponds to 0% earnings per share. In other words, China has been unable to grow earnings except when the economy's been growing at a double-digit growth rate. Wow. So there's the cyclical up and down of earnings and GDP is correlated, but over time, the hurdle that Chinese growth has to reach to get any earnings growth is very high, indeed much higher than the rest of the world. Now this is all part of a huge macro story of the last 30 years. It's really the story of globalization. And I want to take you through a few slides to highlight how globalization has been an uneven force for investors. Now, one of the few things that economic theory arguably has got right over the last 3 or 4 decades is the idea that if we globalise, we're going to see the returns to different factors of production normalise. Now, let me explain what I mean by that. When we opened up our borders, we've seen a huge convergence in the rate of pay for workers in manufacturing. This slide compares real earnings per hour in manufacturing across a number of countries. Be aware it's on a log scale. So Chinese workers are not being paid half of their American peers' pay. But what you can also see is from the mid-90s, Chinese workers were paid on average 50 cents per hour. Now it's $6. That's a huge increase. Compares to relative stagnation in the US. What's facilitated this is a huge investment boom in China. This chart shows how much CapEx equipment the average worker has in China compared to the US. Once again, it's a log scale. The average worker in America has a lot more capital, but China's catching up. And this has been a global theme, the huge surge in investment in emerging economies compared to developed economies. And this slide is showing their investment spending as a share of their GDP. Why does this matter? Well, let's shift away from looking at this macro type data and focusing on what it meant at the company level. Because ultimately as investors, we don't buy economies, we buy companies. This slide looks at how much CapEx is being undertaken relative to sales by emerging market corporates versus businesses in the advanced or developed economies. And you can see a massive gap. Emerging market businesses have been investing at double the rate of their developed world compatriots. Here's the sting in the tail for us as investors. Let's look at the return on assets that these firms are achieving. Back 10, 20 years ago, the return on assets in emerging market businesses was significantly higher than for developed markets. The result of their higher investment is they've effectively brought their returns back down towards the developed market average. Put simply, what's been great for their economies, high investment, has been detrimental for their returns. Now, this slide shows emerging markets in average. If I flip to the next page and just look at China in the context of emerging markets excluding China, you can see that the change has been larger in China than elsewhere. Back 15, 20 years ago, the return on assets in China was higher than in other emerging markets. China's faster investment has led to a reduction in their returns versus other markets. So China is the emerging market story on steroids. Even faster investment than the rest of the emerging market cohort and a greater reduction in return on assets, and as a result contributing to this disconnect between their fantastic GDP growth, their fantastic wage growth, and what investors in the equity space have received. So, to conclude just with 3 points to flesh out, there's no long-term link between equity returns and economic growth. In particular, there's big dilution between earnings per share and earnings, and a lot of that's been driven by very high investment levels in the emerging markets. Globalization was a huge driver of this, and it was a lopsided shock for the world. It was tremendous for workers in China, not so good for workers in the developed economies. It was not so good for investors in China. It was tremendous for many of the big companies in the West. Equity returns ultimately depend on getting the return on capital correct. And the most bullish point you can make for China is the early signs that those returns are improving, but that will require that CapEx ironically starts to diminish. If we see that, we can see a reversal of some of the adverse headwinds that have dominated in China over the last 2 decades. So, great economy, not so good about the investment. The irony looking forward is the economy may not be so good, but it may be a better place to invest in the future. Thanks. Thanks, Vanessa.
Thank you so much, Jared. I appreciate that. So we now have some time for some questions. If you have a question for Jared, Dr. Raby or Dr. Sun, please send it in via the chat function at the bottom of your screen. We're going to take a quick break to give you time to send those questions in, and we will be back in a mere minute. Thank you. Welcome back, everyone. Okay, so we have quite a lot of questions. I'm going to try and summarize some of them to try and get through as many as we can and just do a bit of quick fire around the room with all of our guest speakers. Jared, I'm going to start with you. So, question. Are there greater risks for foreign investors investing in China than they were investing in the USA? Is the Chinese government as receptive to foreign investors as the United States, in your opinion?
Look, I think there are rising risks in China. Geoff touched upon some of the geopolitical tensions. We've seen a crackdown in Hong Kong. Now, obviously from a Chinese perspective, they don't want to damage what is attractive in access to capital global markets via Hong Kong. But ultimately, my reading, but Mr. Raby may have some disagreements, ultimately security and stability comes first in China. And if there's a trade-off there between injuring the access of investors to their market and preserving their stability, they'll choose stability first. Mm-hmm. So no, there are potentially more risks on that context than investing in the US, but the world's bigger than just the US and China when it comes to investment. There are other options, but if that's the comparison, then US capital markets are clearly more open and free than Chinese capital markets.
Do you think that China will continue on this trajectory to be more open? I know there's obviously new policies and whatnot that have started this month, January this year and flow through. Do you think they will continue on that trajectory to become more open and a good place to do business for foreign investments?
I think they'd like to. Yeah. I think they'd like to. But you can't see what's happened in Hong Kong over the last little while as being along that trajectory. I think what they may try and do is set up Shanghai as an alternative to Hong Kong. They would ultimately like to make the renminbi a more important currency in the global FX space. But most experts would believe that to do that, you have to have a more open capital account. So there's tensions there. I'm sure in 20 years, and Chinese policymakers always think in multi-year terms, that's where they want to get to. Mm-hmm. In the near term, when they've got these other geopolitical pressures coming in on them, I'm not so sure it's going to be progress in a straight line.
Okay, fair enough. Another question, similar line, is there any restriction on capital flow between Australia and China, would you think?
Yes, there clearly is. And we've been quite prolific now in blocking some of their investments. Huawei, which was mentioned before, is an obvious one, but there's been other takeovers that have been blocked. So yes, we're becoming less open to Chinese capital than we were even 5 years ago. Mm-hmm. And of course, you could argue that's reciprocal because there's restrictions obvious on us getting in there. So the trade in goods and services is much more open than the trade in capital.
Okay. Dr. Raby, if I could come to you for some questions. There's been probably one of the most popular questions that has come through has been about Taiwan. What is going on with the squeeze in Taiwan? Can you give us some deeper analysis and your thoughts?
Yeah, look, the situation in Taiwan's potentially quite worrying. China is flexing its muscle more. It's sending messages to, I think, the new Biden administration that Washington, Beijing need to find a new accommodation on Taiwan. It's not the first time we've been here. When I took up my position as ambassador in Beijing in 2007, all the talk then was potential war over Taiwan, and those tensions were managed down. I think war is probably the least likely outcome of all the possibilities, and that's simply because it's a lose-lose for everyone. But accidents can happen, and we need to be alert to that. But we have a democratic, the DPP president elect has been elected the second time, and she clearly stands very close to an independent, not quite an independence agenda. They all know what the red lines are as well, and so what we've seen lately, I would still put in the category of brinkmanship and positioning between Beijing and Washington with the new administration, albeit there are many risks.
And some other questions have come through, and you've kind of covered this in your presentation and your speech before, but just to recap as well. If the current account figures for coal and iron ore indicate the continued economic importance of a symbiotic China-Australian economy. What strategic benefit does China intend to achieve by exerting political pressure on Canberra?
Well, first of all, Beijing's responding to what it sees as actions by Australia, which question ultimately the legitimacy of the Chinese Communist Party as the ruling party of China. For example, when we announced the ban on Huawei, it was all about how untrustworthy the Chinese state is. Now, the Chinese party, the party state is a real challenge for any country dealing with it. But it's there and it needs to be managed, and we need to develop our relationships with it. So China also gets benefit, though, in putting pressure on us by sending messages to others that there are ways to manage their relations with China and ways not to manage their relationship with China. And of course, Beijing would like to change our behaviour. And it's been told firmly that won't happen. So we're not going to change our position on Huawei, for example, or change our position on the South China Sea. I think Beijing is sufficiently realist in their understanding of foreign policy to know that's not going to happen, but it does serve a dual purpose of putting pressure on us whilst sending messages to other countries.
You've reminded me of an article that was in the AFR a few days ago, and there is a kind of general thinking that as you mentioned before, that we're being bullied and therefore kind of being attacked almost, and therefore responding. But this particular opinion piece was kind of cataloguing what we had done as a country towards China first. Is there an element where we actually had moved first, but we've seemed to have not taken that into consideration when we're viewing the China-Australia relationship?
Well, Vanessa, that's what was very much a thrust of my earlier remarks, and very much part of what I analysed at depth in my book, that once the US shifted and we shifted with the US, and remember, what the US is defending is not its security. China is not an existential threat to the security of the United States or of Australia. What the US is defending itself against is China's ascendancy, or rather, the US is protecting its dominance. And so the actions we have taken have been very much in that context, and in many ways preceded anything that China has done to us in terms of economic coercion. In fact, by years. And again, I've made that point. Yes, in a sense, our actions preceded many of the Chinese responses, but it doesn't matter who came first or who's right or who's wrong. We have to just take a realistic view of this. We have to deal with it in a hard-headed way. But what I must say here is that when we take actions, for example, the call for the COVID inquiry unilaterally and so on, it actually makes the Chinese leadership lose face. And to the extent our actions have done that, it challenges the legitimacy of the leadership and gives the Chinese leadership no option but to respond and retaliate and to use their propaganda organs and the global times to attack Australia all the time, and social media, because we have challenged, in a sense, the legitimacy of the leadership.
So to follow on for that, we are in the position where we are in. Are there any ways for Australian businesses or the Australian business community to decouple from the Australian government's policies or stance on China? Are there any ways Australian businesses wanting to do business in China can neutralise the government's stance?
Well, the Australian government's position is what it is. Business will find its own way of doing business with China. Where there are measures, like, for example, barley, there are avenues through the WTO that the government can pursue. It's a different question, though, to the extent that the business community has allowed itself to basically let the think tanks and the media delegitimize the business interests in the bilateral relationship. And when we talk about national security, a cornerstone, a foundation of national security is economic security. And whether we like it in Australia or not, the reality is we derive much of our economic security and therefore our national security from China. And these are points that I think the Australian business community needs to be making, not decoupling from the government, not seeking to somehow circumvent what the government's doing, but to have an adult debate in Australia about what it's costing us to pursue these policies, and is the cost worth the gains in terms of the real threats and challenges we face, as opposed to the purported ones, the ones that are asserted but seldom ever demonstrated.
Thank you so much. We'll move to Dr. Sun. We've got some questions that have come in for you, Dr. Sun. You mentioned the new technology, the new economy. Can you kind of elaborate in the coming years? So the new economy is obviously healthcare, technology, consumer staples, and consumer discretionary, Dr. Sun. How do you think the new economy and those other sectors that you didn't cover before are going to fare this year and in the coming years?
Sure. I think I just mentioned the consumer sector because of the consumption upgrade, so-called consumption upgrade. And also, I think we, to one point that Mr. Raby talked about, is the dual circulation theory talked about in China recently. I think the implications for investors is mainly, to me, I think it's mainly on the technology sector. Not just IT, but generally a broad technology sector. I think the reason for this dual circulation, as Mr. Raby mentioned, is it's kind of import substitution. But to me, it's very narrow part of the substitution. I think it's focused in the technology sector. For the rest of the imports, I think China is quite open. For the technology side, it's mainly because of the threat coming from the US during the Trump administration for cutting supply for Chinese companies. So that makes China to make the decision to do this dual circulation, strategy, basically to get rid of the technology bottleneck, so that the industry in China won't be under the threat of the U.S. government. So I think that means there will be lots of investment in hardware, in IT as well, but also not limited to that, to general technology, including software as well. So I think that will create a lot of opportunities for investors. And I also think it's not an easy job, but I think China has a pretty high likelihood to achieve its target, I think. So that's one thing I want to mention. The other you mentioned about this healthcare, definitely as the living standard increase, people's demand for better quality healthcare will rise. And also in China, healthcare in generally today, I think the quality is still quite limited compared to the rest of to US or other developed countries. I think on that side there will be a lot of development as well. The environmental related I mentioned, I think that's probably one of the biggest opportunities in China in the next decade. Don't miss that opportunity. I think investors do need to look into that.
And just a slight follow-up question to that. Someone has asked, what proportion of the total China stock market is occupied by companies that specialize in IT?
To be honest, I don't know. I'm not a strategist. I'm not equity strategist. I'm an economist. I don't look at that. Yeah. Sorry about that.
We can figure out that question and come back to the person that asked later. Dr. Sun, if we can talk about currency for a moment. How will China deal or manage their currency relative to its history? On one hand, a weaker currency helps its export sector, but a stronger currency results in more capital flowing in from foreign investors to support the financing of China 2.0. What are your thoughts on this?
It's a good question. I think at least I think the central bank in China today is not really thinking too much of that. It's mainly having the exchange for FX market to operate as its own on its own. If you look at the FX reserve numbers, the central bank didn't really intervene in the past year. That's why we see fast appreciation. In the past we really worry about. I would say if you ask me this question about like 5-10 years ago, I will pay a lot of attention to the impact on the export sector. But today, this is not that important because we have seen pretty big change in the export sector. It's not so much about labor-intensive sectors. The upgrade in export content in China's export content is quite clear. So it's not, it's not as sensitive. They are not as sensitive to exchange rate as in like 5-10 years ago. This process in the past 5-10 years ago was already quite painful because of the structural change. But as of today, I think exporters, they care about exchange rate, but it's probably not as much as in a decade ago. And on the other question regarding the capital inflow, I don't think the government really or the central bank really wants to have a strong currency to attract capital inflow. China has such a high reserve, FX reserve, and also we are seeing too much of inflow, in my personal view. I think at this stage, the two factors are not that important for the central bank. I think more important for them is to create this, clean, this is the free floating exchange rate mechanism for them.
Dr. Sun, given time, do you think the Chinese currency will become the global currency?
Oh, it takes decades, I would say. Will be one of the. I will say this way: the RMB, the renminbi will become one of the important pillars in the international currency regime. US dollar is one, euro is one, and I think based on the size of Chinese economy, RMB has to be one of the pillar currency in the world. But it's not going to be a short-term issue. It would take at least 10 to 20 years, I think, to achieve maybe a status of euro, not even the US dollar, I think.
Mm-hmm. Jared, would you agree that kind of timeline in terms of the renminbi becoming the global currency, or at least up there with the US dollar?
Yes, it will take years. The interesting thing is the world's reserve currency has been one of the perks of being the dominant power through history, from the Spanish to the French to the British, now to the Americans. If we're moving to a multipolar world, it's not clear that you have an absolutely dominant reserve currency like we have had for most of the last 2 centuries. And it may be analogous to a multipolar world. We have an FX system where you have 2 or 3 prime currencies. And in that, I'd absolutely include the euro. I mean, the euro at the moment is as big an economy, if not bigger than the US in aggregate, bigger than China, and has an open capital account like the US. So in a sense, the 2 prime currencies that are first in line to sort of take over the mantle, continue the mantle in the US case, is the euro and the dollar. China, obviously the third candidate, but I think it is a multi-year project.
Mm-hmm. Okay, so we've had some questions come through specific to your presentation. Jared, what is the main reason, do you think, for low ROE in China, e.g. dominance of state-owned enterprises?
I think that's absolutely a big part of the reason. I mean, a lot of firms in China, even though they're listed, it's not shareholder primacy over there. There's a whole lot of social considerations, and that's reflected in low return on assets, low return on equity, and that drags down the Chinese aggregate. The honest truth about the Chinese market is averages are slightly misleading. If you look at the average Chinese index, and there are a few of them to choose from, it's like a curate's egg. It's good in parts. You've got some very fast growing, very efficient, very expensive companies, obviously in the tech and consumer space predominantly. And then you've got some below par, worn out industrial companies. And then you see you observe an average, like I've used in my slides, but really there's a huge disparity between the very best Chinese companies and some of the laggards.
In terms of sentiment outside of China and investors investing into China, how much of that do you think plays into China's growth? So how much does Western world openness to investing in China relate to China growth, do you think?
Oh no, that's absolutely the carrot that gets everybody looking at China, and indeed other emerging markets as well. But I mean, we've been through, in the developed world, obviously a very disappointing decade of growth. And what we've seen is any company or any sector that can generate some growth in a slow world absolutely attracts a lot of capital. And that's the handful of successful US companies we all know about, but the handful of Chinese companies, and the whole idea of an economy that is able to grow at 5 or 6%, as we heard in the first presentation, has rebounded very quickly from the COVID crisis, is obviously going to be on every investor's radar screen. The catch is, it's one thing to look at a place because of the good economics. You've then got to find the specific company that delivers on that promise. And that's where the gap is. And at the index level, there has been that gap there for 2 decades. So you've got to choose carefully. Having a company in a fast-growing economy doesn't guarantee it's going to be a good investment.
Okay. On that theme, we've had a very specific question. Jared, if you were given a global equity mandate with a long-term horizon of 10 years, what percentage allocation would you consider to China?
Right. That's a tricky question. Let's put it this way. It's a global. I would have less than normal in the US. The US is a very expensive market. I would have more than normal in markets like the Asian emerging markets, which I take broadly to include places like Korea and Taiwan, and Japan. So it's all up there. Japan, I won't bore people with. This is about China, this symposium, but it has a structural story to it. I am put off a little by the geopolitical risks in China. I mean, that, I think as an investor, you have to recognise that that's a risk factor. But in terms of the growth opportunities over multi-decades, compared to what are the very expensive markets and stocks in the US, it's got to be in this part of the world. My personal biggest bet would be Japan, but I'd have some other money in the other markets in that region.
Okay, so more than zero, we could say.
Oh, absolutely. Yeah. I mean, this is too big a market to ignore. It is now the second largest equity market in the world, depending on which index you look at. So if you're a professional investor, it would be an enormous risk to have no exposure to China. It's whether you go above or below normal. And that's where I think the politics is a factor. And something I didn't discuss, but China does have some of the hallmarks of an economy that's starting to secularly stagnate. Like the demographics are not good, there's a lot of excess saving. That's a separate issue. I would rather play, I'd be as interested in India as I would China.
Okay. Well, thank you so much, Jared. This brings to close the first of what we hope will be many China Investor Symposium. So I would like to thank Jared. Thank you, Jared, so much for joining us.
Thanks,
Dr. Sun and Dr. Raby, thank you to both of you as well. We really appreciate all the analysis and your time today. I hope everyone listening has learnt a lot. I know I have as well. So thank you, everyone. And thank you so much to everyone that's joined us and tuned in today, especially, I know there's been many VanEck clients and investors who've tuned in. As you know, we at VanEck are passionate about helping educate and empower investors. If you are interested in learning more about ways you can access China A shares, we have 2 ETFs for you to consider: the VanEck Vectors China New Economy ETF and the VanEck Vectors FTSE China A50 ETF. You can visit our website for more information. For now, I look forward to seeing you hopefully at our next China Investor Symposium. Hopefully by then we'll be doing this in person. But thank you so much, everyone, and please take care.